chapter 4. So chapter 4 is accounting for merchandising operations. We'll start at, you guys know you're laughing on a thing that's going to be on YouTube. Somebody's going to be like, who in the world and what accounting class do you teach? Everybody is happy.
50 Shades of Taxation.
So, all right. So up to this point, right, so at this point, we have done our income statement just like this, right? So revenue, expenses, and net income, right? So it's what we call a single step income statement. Let me see if I got mine. Oh, I can't find it. I'll write it here. Single step. So up to this point, revenues have been on top, expenses have been on the bottom. These are great for the service industry, right? So accounting firms, law firms, plumbers, anybody in the service industry, these are income statements that work for them. Now we're going to move forward into merchandising and manufacturing. And when dealing with merchandising and manufacturing, we're going to extend out the income statement. Why? Because now we're talking about product. Product being purchased, right? So whether you're a manufacturer and you create product and sell it to whether it be the customer or a merchandiser, or you're the merchandiser and you purchase product from a manufacturer and sell it to a customer, right? You have product going through your company. So now we're going to discuss how we deal with companies that have product rolling through their company.
Can we go back one slide?
Sure. And what we're going to do with those companies, we're going to make what's called a multi-step income statement. Right? Now, this is a much more complicated income statement, and it's sad to say, but this will be the income statement that you'll see for the rest of the semester. Okay? So a little bit harder, a little bit more going on. Everybody finished with this slide?
Yeah.
Okay. So I'm going to skip forward. Robertson, don't make me kick you out. Other people pay for this course.
Is there a difference between like net income and profit?
No, there's synonyms. Great question. So Maddox asks, is there a difference between net income and profit? There's synonyms. What is going on is if you say profit, that's normally used in the business context. You say net income, that's normally used in a context of accounting. So in accounting, we'll always say net income, but profit is basically the same. That makes sense? You say earnings, you're normally talking about a financing base. That makes sense? All right, so we're gonna expand we're gonna expand this income statement. Let me show you what it's gonna look like. Oh, here it is. So when we expand this income statement, it's gonna look a lot like this. So we'll start off with sales, gross sales. Remember, we're selling product here. So we're gonna start off with gross sales, minus discounts. Everyone knows what a discount is, right? What is it?
A reduction in price.
Yeah, just a reduction in price. If you buy 1,000, we'll give you a 2% discount. Everybody with me? So that's a discount. Then we have returns and allowances. Everybody know what a sales return is, right? What's that, scholars? Sales return.
You give something back, you get.
Right. When the customer brings back product because it doesn't meet their specifications, and you refund it. That's a return. What's an allowance? Does anybody know what an allowance is? It's not as frequent as a return. So allowance is something that's normally given from the manufacturer to the merchandiser. But an allowance is, let's say for instance you get, let's say Tide, right? Tide is created by Procter & Gamble, and they sell it to Walmart. And they sell it to a Walmart right here in Dulles, and that Walmart gets the Tide box, but let's say there's a dent in the box, right? They'll say, so the Walmart here in Dulles will call and say, hey, there's a dent in the box, it doesn't meet our specification. Procter & Gamble might say, look, that box cost you $5, why don't we just charge you $4.50 for it if you keep it? That way we don't have to pay the expense of sending a truck out to pick it up. And they agree. That 50-cent reduction is not classified as a discount there, but it's classified as an allowance, right? It's a reduction in order for them to keep product. Otherwise, it would be returned. Everyone with me? So that's an allowance. So sales minus discounts minus returns and allowances gives you net sales. Subtract cost of goods sold and we'll get gross profit. Okay. Cost of goods sold is something that we'll be dealing with in the next 2 chapters. Okay. That is the cost that it takes to bring a product up for sale. It's everything that's in cost of goods sold. Go ahead.
This is not gonna be on mute, is
Yes, it is.
that right?
No, oh, which one? This one, weekend?
Yeah,
No,
okay.
midterm. Okay. Operating expenses are next, and general administrative expenses go. And then there's a part of this that's not here, but I'm gonna talk you through it. After this, before we get to the net income, we have what is called, go ahead.
Do we add subtract operating?
We subtract these operating expenses. So here's total operating expenses, gross profit minus operating expenses gives you, well, here in this case they're saying net income. But I'm gonna stop that for a second because there's something after operating expenses. And they're called extraordinary gains, losses. Oops. Loss. Extraordinary gain or loss, right? Now, these are one-time events, right? They're not your day-to-day operations like up here in sales and cost of goods sold. These are events that happen once. So as far as an extraordinary gain, to give you an example, it's like selling a building, right? You sell a building, you're gonna only sell it once, you made a profit on it, so you have an extraordinary gain. Well, all right, I got you. And then on the other side, extraordinary loss will be maybe a natural event, like a hurricane, damaged the roof of your building, you had to repair it, that's an extraordinary loss. That's not an expense that you're gonna always incur, but it is a one-time expense. Everybody with me? So that will go after the operating expenses. Go ahead.
Wouldn't a lottery be considered an extraordinary gain?
Yes.
So that's not for companies, right? Like companies, like if somebody wins the lottery, would that go at their company at all?
If the company went and bought some lottery tickets, and one of those tickets hit, yeah.
Do people do that actually?
Not normally, right? It would be so let's say no, right? Because you would have to, remember, companies have a board, you'd have to explain to the board why it's more profitable for you to buy a lottery ticket than to,
Spend money advertising.
right, spend money on advertising or promoting the product or research and development to making the product better. Does that make sense? So that would be a tough one.
Humans can do that. Like regular people, businesses have no need to do that.
Yeah, I would, it's very, very, I've heard in the past of one company, the lottery getting so high, that one company did purchase some tickets, but,
Like the Powerball or whatever.
yeah.
Can you give an example of a gain? Like
Oh.
extraordinary?
So I said, if you sold your building,
Oh.
you made a profit on it, that would be a gain.
Oh, thank you.
Something that happens once.
Right, one time. Another thing that might be a gain is, let's say for instance, you do a transaction with an overseas company and you make money off of the currency exchange. That's a one-time gain. That make sense? If it's not a normal transaction, you do it and let's say when you initially did it, they gave you $1,000 in euros, but the U.S. currency strengthened, and when you changed it over to U.S. dollars, you ended up getting $1,010. That $10 would be an extraordinary gain because you just made money off of the exchange rate. And so after this, you would get what we call EBITDA, EBITDA. And that is earnings before interest, taxes, depreciation, amortization. Scholar in another class asked me what amortization is, so I'm gonna make sure to tell you guys what amortization is. So amortization, depreciation, we talked about depreciation in chapter 3. I said that was an estimation of use of long-term assets. When you're talking about depreciation, that asset is tangible. When you're talking about amortization, that asset is intangible. So we depreciate things such as cars, buildings, equipment, things that are tangible. We're gonna have a chapter about that. You'll love it. And then we amortize things such as bond interest. We amortize trademarks, copyrights, and all of those things are intangible. That make sense?
So it's like depreciation for intangible goods.
Yep, that's exactly right. It's
It's the same
depreciation.
definition.
Yeah. Exactly right. Everybody with me? So once you get to EBITDA, you're gonna subtract depreciation amortization to get EBIT, or EBIT, as one of my colleagues loves to call it, EBIT. Earnings before interest and taxes. Subtract the interest, you get earnings before taxes. Subtract the taxes, and you get net income.
Why is it E?
Earnings, because we're in accounting, that's why it's net income. You're not earning. No, I'm not trying to be a jerk.
No, I'm lost if like the ED turns into an NR.
Right, net income.
I mean, EBT is earnings before taxes, you subtract taxes, that's net income.
Then
It changes the name. I don't know if it's the same thing.
Don't question it.
No, if this was finance class, I'd be like, oh, and this becomes earnings. Right? Just what we were talking about earlier. And if I was in business class, I'd be like, and this is profit. That make sense? Well, we're in accounting, so this is net income. Yeah, it's like this and this are the same.
Miss me with that stuff.
Huh?
I said,
You
miss me with
missed
that stuff. 10 or 10.
So is there a whole sheet for this formula that you do before you go to the income statement?
You just have to know it.
You talking about here? No. You got it. You do need to know this. But you really, I'm taking you further than the purview of principles. you'll need to know this for anything else you go to. Like Finance One, if you go to intermediate accounting, what have you, you need to know the extension. In this class, we'll probably just do operating and general administrative and do net income. We'll skip this. That makes sense?
Yeah.
But I don't want, we're gonna talk about extraordinary gains, we're gonna talk about extraordinary losses, we're gonna talk about taxes, and we're gonna talk about depreciation. But I don't want you guys to, I don't wanna skip over it. That makes sense? And show you, hey, this is where it goes. Good. Good questions. Let's see, tell you what. We'll do one transaction, and we're gonna do, we'll go to the income statement, and then that's it. So, this is a purchase of merchandise. Jason Inc. purchased $14,000 of merchandise, they paid cash. Is it cash or credit?
Cash.
Cash, what type of account is cash?
Asset.
Asset. Did we increase or decrease the cash in the company?
Decrease.
How do we reflect that, how do we reflect a decrease in an asset?
Credit.
Credit, okay, what did they use the cash for? Merchandise inventory, merchandise inventory is what kind of account?
Asset.
Asset, right? Did we increase or decrease the merchandise in the company?
Increase.
How do we reflect an increase in an asset?
Debit.
Nobody's dropping this class. We just killed that.
No, I'm not really more worried about you guys. Remember, as I said, there's probably about 48, 45 people on the roll. There might be 40 of you here.
This is also a very easy question.
Just don't worry. When we go to the midterm and we need 2 classrooms of computers, you'll be like, who is that person? Like, I've literally had siblings meet in the midterm and figure out they were taking the same class. One sibling never came.
So you swear.
I'm dead serious. One sibling never came to class until the midterm.
Wow.
And they were like, dang, I didn't even, I've had co-workers meet at the midterm.
Okay,
Like,
siblings is
I didn't know you were, right. That sibling thing was crazy.
y'all get together too.
He was like, dude, I didn't know you were taking a class. I was like, I didn't know you was taking a class.
They never talk to each other about the courses they're taking? What the
Dude,
hell?
hey man, your siblings, one is great in class and one didn't come. Alright, so trade discount. So trade discounts, just like we said, is a discount for materials. If Matrix Inc. offers a 30% discount for 1,000 units to be purchased of, let's say a racer. Each racer is $5.25. What we do, if they bought 1,000, we multiply by the price, and then we'll take the discount. We always, you'll see in a couple of slides later, when we do the discounts later on, if you have a return or an allowance, you'll take that before the discount. Everybody with me? But here it's just a discount, so we're just gonna take it. Oh, one last thing about discounts. The other class, your colleagues were like, is this for real, Professor Jenkins? I'm like, yes. People get caught up on this, and I wanna make sure that when you're doing your midterm, you don't get stuck on this. When you're taking a discount, you see it's 30%. In this case, it's, do not take $5,250 and multiply it by 30. I mean, right? Because then you're gonna get,
Massive number.
right, you're gonna get this for your discount, 6, 7,
15,700.
oh, 15, you're right. Oh. You get 157,000. And then start trying to subtract, right? It is by 0.3. Everyone with me? So just make sure when we're doing those percentages on your midterm, you see 30% is 0.3. Go ahead, Alan.
You could do 700 times 5.25, right? If you want
700.
Because that's 30% of
Oh,
30% of 1,000.
Oh,
30% of 1,000.
Yeah.
You give me just 30% of that for free.
30% of 1,000.
If you-
That's
Or take 70%. Are you talking about taking the opposite of this? You just said 700.
Yeah.
Like instead of 1,000 units, just do 700.
They're taking the 30% and just
it by the price. Yes, it works for you.
It's a lot of math.
If it's faster for you, that's fine.
Whatever works for you, man.
All right, so that's it. The next slide would be invoices. So